Good morning. It is Monday, November 22nd, and this is this week's Clubhouse Insider Market Update. So what's going on with mortgage rates? Well, rates are starting to move down. We've been talking about that here over the last month, right? This is the 10-year Treasury. We like to talk about that being as closely tied to mortgage rates as anything out there. But we know that we had a great August. And then, of course, what happened last week? The Fed meeting. So the Fed came out, they announced their decision, 25 basis point cut to the federal funds rate, which we've ad nauseum described. But with the Fed, there's several factors that are pushing rates downward right now. But we want to just make sure we really are careful with our expectations going forward. So with the Fed, they've cut the first rate of the year, and markets expect more cuts ahead. So what was really talked about was 2 more cuts this year, one in 2026 and another in federal funds rate is an overnight rate that they charge each other, right? The banks and the institutions. And so when we hear there's 2 more cuts this year, that's great news for them. But only one in 2026 and one in 2027, that hurts the longer term rates. So mortgage rates took a dive, the end of last week, Thursday, Friday. So here's the meeting right about here, and boom, we went back up. So if you go from here to here, though, that was about 25 basis points that the market had already priced in. So the lack of cuts planned for the future, that's something that we want to keep our eye on. So investors are already pricing these things in. Remember, everything in the markets work on expectations. So things are going to happen slowly, but they are happening, which is great news. So for example, today, the mortgage markets opened unchanged, which never really happens. Usually there's something here and there. So maybe we're finding a little stability here, and we're going to start seeing things slowly but surely coming down. These next 2 cuts at the end of the year, that could be really something that could be exciting as well. But, we talked about it all being priced in. The Fed gave their outlook and for the next couple of years, and, we're just not so sure. So here's the key thing, though, that we want to pay attention to. While rates are trending down, there's no guarantee that they're just going to fall or bottom out or even keep coming down. So what the Fed is so focused on is the data. They always talk about that, especially Jerome Powell, whenever he gives a press conference. Every time he talks about the data, markets react in a negative way, it seems like. So those 2 cuts, one in 26, one in 27, that's a big factor that he mentioned. But other things like inflation data, jobs reports, anything at all, the Fed could signal and have the power to push the rates back in the wrong direction. So even though they've dropped, they're still historically on the high side, especially versus the pandemic era lows that everyone got so used to when budgeting for housing. So really, I was told, a while back, I had a really great conversation with an economist, and he talked about 6% being a really healthy average for an interest rate for a house mortgage interest rate in our market. So we're right at that right now, which the market isn't quite healthy in all areas, but there are some points that are healthy and some points that aren't so much. So there's just a lot of data dependent stuff that we're really going to have to pay attention to. But the key question on the table is how much lower? That's what's so uncertain. We don't know how much lower we can get. So here's a chart of the mortgage rates just from August to now, right? So we really got a nice one, and then boom, there's that dip from the Fed. But still, overall, we're down over the last 2 months. How much lower can we get? Some people are predicting into the mid-5s if things go really well. But when we started the year, I joined a lot of calls, a lot of these national experts who are really well trusted. They were talking about getting down to the 6% range. And whether we like that or not, we are on schedule for that 2025 year prediction. So whether it gets into the 5s, maybe we need a little bit extra data, something to show. These jobs reports where we're showing fewer and fewer jobs being created, things like that are going to be something that make the rates go lower. So those are the kind of things that could upset these experts' predictions, but that's what we're looking at. So with all this said, we're sitting right now just over 6, right? But still under 6.5 on a conventional rate. But check out the 15-year. There's a 5. Okay, there's some ARM rates that are showing in the 5s, and FHA and VA are really, really close. They're basically in the 5s if you have great credit. So we're getting there. And with that, then, as today's spotlight is refinance demand is picking up. So homeowners who have bought or refinanced when rates were higher, they're starting to explore options. So that is where I can step in, and me and my team can step in. So whether you're looking to refinance or locking in a dip like we had last week, and I was able to have some customers take advantage of that dip before it spiked because of the data that we're watching here, or just setting up a plan for your next move, now is the time to review a strategy. We've got to get a strategy together so that when a dip happens, we can act. So the bottom line that we want to think about going into this week is the market is giving us a window of opportunity. So the question on the table is, will you take advantage of it? So reach out to me and let's see what makes most sense for you. Have a great week, everybody.